Tech stocks, but dipping again today after last week's NVIDIA-driven sell-off. Our next guest, though, says other sectors of the market could be ready to break out. Chris Verrone, head of technical and macro research at Strategas, is back with us at Post 9. Welcome back.
Great to be here.
I just got a note in my inbox from one of the places on the street, and the headline is, with signs of the rally stalling, we remain defensive. Is the rally stalling or just rotating?
I think this is a very rotational market. I mean, think about the last couple of weeks. There's been these little shots across the bow with tech. We've seen it with NVIDIA. We've seen it with Apple. But the daily breadth actually has not been bad. We're still talking about 75% of the S&P above the 200-day here. So to call this narrow or justifying some defensive posture here, I think is a bit too far at this moment. There's maybe a hint of life from some of these defensive groups, but that's after 12 months of nothing. To say those are trend changes, I think, is very premature.
Well, like utilities? I mean, you like utilities, right?
Yeah, well, I think there's a difference between your laggards at least going up in price, and utilities have been laggards for the better part of the last year. Sure. At least they're not going down.
Well, I'm trying to think of defensive groups that you would maybe be referring to.
Well, I think the biggest justification for anything defensive right now would probably be healthcare, to the extent you even want to consider it defensive. I mean, we're talking about something like 80% of healthcare stocks in an uptrend. That's the best reading in 3 or 4 years. So there's been some clear improvement over the course of the last 3 or 4 months in that sector. And it's against the backdrop of what has been really liquidation if you look at the flows in healthcare. So this kind of powerful cocktail, this powerful combination of healthcare setting up well as the market maybe takes on a touch more of a defensive tone.
What are you telling clients about technology and that trade right now? Because that's top of mind for everybody.
Absolutely.
NVIDIA sort of made it that way on the way up, and then the reversal on Friday.
I think the biggest punchline is there's a difference in this business between a top and a correction, or a top and a consolidation. I think this looks consolidative in tech. I don't think these are big top formations taking shape. Now, there's clearly an emotional element to this. The flows have been excessive. The options are excessive. We see it just in the discussion on the show all the time. There's an emotional element to where we are with tech. I went back over the weekend and I looked at how all the real parabolic stocks peaked in 2000. And what you learn is it wasn't a single day. It took months and months and months of distribution. We've had one noted reversal in NVIDIA from a very extended spot. Could this be the start of a correction? Absolutely. But I think if we're going to start talking about big top formations, we're not going to know that for months and months. The only stock that's actually done that thus far is probably Apple. Ironically, it's oversold here, probably bounces, but that's the one in tech, maybe Adobe
Tesla,
as well.
I mean,
yeah, Tesla in the spirit of the Mag 7, but within tech in particular, Apple and Adobe are really the two that look like they've topped. I think that's a difference from saying, hey, NVIDIA is vulnerable to a correction. Two different stories.
I mean, now but we're having this conversation of whether an NVIDIA and Meta market, as we say at the top, at least as it relates to big cap tech, just becomes an Alphabet and Apple market for a while within that group. That money comes out of the leaders, goes into the laggards. So maybe even that idea is premature to declare that those stocks have topped. Who knows? You
know, but where you look at, I think the big change in Google, the big change in say, Apple is in the relative standing of these stocks. I mean, they've been deteriorating in their relative standing for the better part of the last 6, 7, 8 months. I mean, Apple made 52-week relative price lows, right?
No, that's fair.
I think if you got bounces here in Apple or Google, they are oversold. If you got bounces, you'd be wise to reduce exposure into that. But, Scott, take a look back at the bigger picture here for a moment. After almost 600 trading days, the equal weight S&P made a new high last week for the first time.
That's right. One fifth of the stocks within that also made new highs. So it's not like the broadening story is just limited to a very small group of stocks.
And this is rotational. And listen, I get that all the big weights, all the index weight is maybe vulnerable to a correction here. But the average issue is okay. I mean, energy is perking up here. Materials have perked up a little bit. Utilities, you note. Healthcare, we note. So there's a difference between a correction and a top. Maybe this is a consolidation.
But quickly, before I let you go, you also say that tech is entering one of its weakest seasonal periods as well, from the period of March to May,
March to June, let's call it. You know, seasonality is conditional. I don't think you make calls on seasonality, but it can help fill in some of the gaps.
I haven't heard that. Like, why is that the case?
Yeah, it's funny. Tech is historically not a very seasonal sector, except for these 3 months. Conversely, this is a very good 3-month stretch for energy, materials, copper, gold, and I think we're seeing certainly life in gold. Copper, watch copper at $4 here, very close to a big breakout.
All right, I'll see you soon. Thank you. Chris Verrone, Strategas, joining us right here at Post 9.